mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and for the first time in a very, very long time, I am sadly not joined by my equity buddy Ren. Unfortunately, circumstances have meant that he will not be able to jump on this intro with me despite his every attempt. So that is sad news, but it's okay because today we're bringing you another interview in our Expert Investor series, something that we haven't done for a while now. So we're very excited to do that. And good news is Ren is part of that interview. So for those of you who were sad that you wouldn't be hearing his voice, have no fear, you will be hearing it. Before I jump into introducing our fantastic guest today, there are just a couple of bits of housekeeping that I want to do, as always, for all of our equity mates. So firstly, if you haven't already, please jump on and start following us on Instagram. We are not just pumping it with memes, despite my every effort. We're actually using it now as a platform to provide you all with some inspiration and new concepts. So during the week, we'll be doing things such as pardon the jargon, going through some key terms that you need to know as an investor. We do a company in the spotlight. You know, there's a lot of companies out there at the moment on the ASX, the Australian Stock Exchange, that as a beginner, it's very hard to come across and find. So we will be putting a company in the spotlight, an Australian company each week, just to give you some inspiration and give you an idea of how many companies are out there and then what they do. We'll also be going through some news and of course we make mention of our Thought Starters weekly email every Monday. So please follow us on Instagram. It's turning into a pretty nice little resource for all beginner investors. Also, we're getting a lot of questions coming in from new listeners. You know, which episodes should they start listening to? Should they start at the start? Should they start at the current and work backwards? So what we've decided to do is we've collated all of our Basics 101 episodes into one sort of nice little package that can be found online on our website, equitymates.com/essentials. And that's probably a good place to start. And also, if you have been listening to the show and want to refer back to episodes that are all about the fundamentals of investing, that's the place to do it. It's called Essential Learnings, and it's all of our Basics 101 episodes. So that's a great point to start if you are unsure where to start listening. So jump in and have a listen to that. You can use it as a point of making a list and then use it through Spotify or iTunes or however you listen to your podcasts. And finally, just a reminder that we do have our Ask Us Anything forum online. So if you want to ask us anything, please do. And what we will be doing is then answering all your questions that come in over the month in the last episode of each month. And we really look forward to doing that episode because there are some fantastic questions that come in from our listeners and they are incredibly beneficial for everyone to hear. So if you have asked us a question via email, Facebook, whatever it may be, and we haven't responded, then that is because we are waiting until the end of the month to do so, unless it's critically important, and we'll respond on the spot. So that's some housekeeping. So today we are excited to bring you an interview with Chris Brycki. Chris is the CEO of StockSpot, which was Australia's first ever digital investment advisor. Chris has over 21 years of experience in investing and has spent most part of his career as a portfolio manager at UBS. He came straight out of uni and went into managing money at UBS, so a pretty awesome job. He holds a Bachelor of Commerce from the University of New South Wales, and he's also a member of the ASIC Digital Advisory Committee, so very experienced. He's a pioneer in the investment advice and personal finance space. He started StockSpot when he was 28 years old, when he realized that consumers were being taken advantage of by unfair fees and there was a bias towards advice when they invested. So we dive into all things StockSpot. Probably one of the more exciting parts for us was that he's very famous for winning the ASX high school share trading game 3 times as a teenager, and that's something that Ren and I are playing at the moment. So it was great to sit down and try and get some of the strategies that he used back in the day to see if we can put it in place, because I know some of our equity mates are also playing along with us. So in this interview, we discuss a wide variety of investing topics, everything from the Basics 101 through to creating great portfolios, and also why it might not be the best idea for me to be sitting in cash at the moment. So we learned a lot from Chris, and we hope you do as well. Enjoy. So we are joined by founder and CEO of StockSpot, Chris. And we're very excited to have him on because I think he has a fantastic background that is going to be incredibly relatable to many of our listeners out there, Ren. So excited to have you on the show. Thanks for being with us, Chris.
Thanks, guys. Thanks for having me on.
Before we get into StockSpot, there's some really interesting points that we want to cover about your background and your career. And as we were just saying off air, then, we started Equity Mates to try and encourage as many millennials as possible to join our journey as we learn to invest and battle our way through. We've all got to start somewhere, and you bought your first stock at 10 years old from what I've been reading. So to kick off for our listeners, sometimes the hardest part is pressing that buy button. And usually one of the reasons is, I don't know what to buy. So at 10 years old, what was the stock that you bought and how did you actually choose it at that age?
Well, yeah, I'd say it was probably a lot harder back then because you didn't have podcasts and the internet and all these sorts of research resources. So, back then my research process was looking it through a newspaper, if anyone knows what they are. And the first stock I picked, so my dad sat me aside when I was 10 years old and said, look, this is how the share market works. And as an exercise, I'm going to give you $1,000 to invest and you can choose one share. And he sort of opened up the paper and said, here are all the different options you have out here that you can buy, all the different shares. And there's obviously the hundreds and hundreds listed in the papers. So I studied the paper for a few weeks and read a few articles. And then I decided to buy a company which doesn't exist anymore, but it was called Savage Resources. This was back at, I think, based on my diary, it was in January 1996. So I just turned 10 years old. And I kept a diary actually for the first couple of years of every share that I bought, why I bought it. I cut out newspaper clippings to which sort of, showed how it was going. Every couple of weeks I'd update what the high price was and the low price was and what my percentage profit was, which looking back, I can't believe I actually knew how to calculate that sort of stuff.
Yeah, it's amazing.
And kind of watched and learnt over a few months and watched the share price go up and down and my profit go up and down. Unfortunately, a few months later, first of all, I sold it and made a 22% profit in, I think, about 5 months. And then I went to my old man who'd bought it for me and said, okay, Dad, thanks. Can you give me the profit that I made? And he said, look, Chris, I'm sorry, but that was just an exercise. I didn't actually invest in it for you so that there isn't actually a profit.
Oh, no.
Oh, no.
And yeah, you can imagine like as a young 10-year-old getting ripped off by, a function of a few $100s by your parents and how that feels and the sort of trust you lose in your parents at that young age. So I think the hard lesson I learned, first of all, is not to trust my old man. But it probably made me more curious and more interested to do it myself. I sort of decided, okay, well, if they're not going to help me out here, I better learn this stuff myself and actually put my own money in.
So I think the discipline of filling out an investing journal, especially when you were, 10 and 11 years old, that's a great lesson right there for our listeners and definitely something we would suggest people do, especially when they're starting out. Looking back on that investing journal, how did you go in your first couple of years? Were there any lessons that stood out or any mistakes that you made, over and over again?
Well, yeah, I totally agree with you guys. Using a journal for investing is really useful because one, it creates some sort of discipline and like investing or trading, depending on how you're looking at it, it is really like a discipline. And it helps you kind of overcome your emotions because you can, write down and then refer back to why you bought something or why you sold something. In terms of lessons, so that was in 96 that I started. And I think from that sort of 96 to 97 period, resource stocks were kind of the hot area. And so I think that was where I was sort of focusing my time and a lot of news articles were written about resource stocks. I think I made a bit of money in that area. And then the attention turned towards tech stocks in sort of the 98 to early 2000 period. I think, to be honest, I don't think I learned too many lessons in that period. And the reason I say that is I think you learn a lot less when you're investing, when you're making money. So, I was reading the newspaper, buying and selling stocks and finding it pretty easy. So the easier you find it, I think the less you think about it and the more that you're attributing those profits to, I must be good at this, I must be skillful, I must be better than all the other people out there reading the newspaper. I think my big lesson probably came then in early 2000 when a lot of the money that I had built up from trading and doing quite well, I lost, within a matter of weeks. And when you lose money, I think that's when you actually learn learn real lessons investing about, risk management and the importance of diversification. But also, I think the most important lesson is learning that you don't really know very much at all.
So how old were you in the 2000s where you'd lost all or majority of your money?
So I think the big fall sort of started around March or April 2000, and this was a market that had gone up by, I think it was like 20 or 30% just in the couple of months prior. So it was very, very hot. Every stock you were buying was sort of going up. I think within like a few weeks, within a few months, I definitely lost sort of 70 or 80% of what I'd made, which was definitely in the thousands of dollars. So, that was a pretty big amount for I would have been a 14-year-old at the time.
Yeah. So what was your strategy from that point there? Did it really put you off investing for a little bit? Do you need to sort of lick your wounds, or were you just straight back into it?
Well, I mean, it taught me one very big lesson, which is, and it's the same sort of lesson when you go to a casino, which is like, you can't make any more bets when you've lost all your pot. And so the most important lesson when you're investing is to really protect your wealth as well as grow your wealth. And because I lost such a large proportion of what I had, and I think the small amount that I had left over was stuck in tech stocks that were barely trading and pretty illiquid and probably hard for me to get out of. Anyway, it actually gave me a few years where I actually couldn't invest anymore because I actually didn't have any money to invest. So I probably spent a few years then reading books and trying to learn and doing all the things I probably should have done from the start because I had the time to do them. Yeah, it was. I mean, I always think it's the most valuable lesson for anyone when they're starting to invest is to lose money early, because one, that sort of kicks off your learning a lot quicker. But also, if you lose it early, that's going to teach you lessons that will help you avoid losing much bigger amounts later on.
Yeah, so those lessons obviously paid off because you went from losing that money to winning the ASX Schools Sharemarket game 3 times. Now, Bryce and I are currently playing it at the moment, and we're definitely a long way off winning it. So while we have
Come on, back yourself.
All right, well, I'm a long way off winning it. Can't speak for Bryce. We've got you on the show, so we figure it's the perfect time to pick your brain and get some good tips from you. So I guess...
Do you want tips on air? I mean, you might want them off air, and I'll give everyone
true.
else that.
True.
Yeah, we might get some shocking tips from you. Let's start with the story of the 3 wins, and then let's go into, I guess, how you did it.
Yeah.
Sure. Well, as I said, I was pretty fascinated by all of this stuff when I was even a few years younger than when I started playing this game. I started high school, and I think it was in year 7. I heard about this ASX share game, which was a way to kind of hone in your skills of trading. At the time, my school didn't have any entries in this competition. So I actually remember going to one of the teachers in the school. He was my geography teacher who I liked, and said, hey, to enter this competition, you need like a sponsor teacher. Would you mind signing off on this form for me so I can fax it into the ASX? And the teacher said, okay, yeah, sure, no problem. So I filled out the form, entered my team and faxed it into the ASX. And for that year, I was the only entrant from my school. Now, 4 or 5 years later, I think our school had the most entrants out of any school in New South Wales, because everyone had seen that I'd won it a few times and thought this was like easy money. So yeah, we had a huge following within our school just within a matter of a few years. But at the start, there wasn't too much interest. I think around Australia at the time, there was about 50,000 people that were entering it. So it was a pretty big competition though at the time. And I think the rules haven't changed between then and now. So I think you got $50,000 to invest and you got to choose from the top 200 stocks on the ASX. And you had a period of 8 weeks to buy and sell. You got charged brokerage just like you would in real life. You could put in orders that were at market, so you bought it at the price at the time or at limit, and wait for the price to come to a certain level. I don't think there were stop losses at the time. I heard you guys on a other podcast talking about having stop losses. We didn't have that back then, so you actually had to manually go in and do that.
All right.
And then I remember going to the school library at lunchtime and working on it after school, trying to pick, what stocks I'd be buying and selling to try and win this prize money, which, as you'd heard, I'd lost a bit of money from trading. So I was trying to make some back so I could invest it. And prize money I thought was a much easier way than working at Woolies or DJs like a lot of my friends.
Can you remember what your profits were when you won in your first year as a percentage?
I think it actually varied quite a lot game to game. So the first one I won was in actually 99. So it was actually before the big tech wreck. And I think for that year, the profits were actually quite large because tech stocks were all on fire. So I think the winner in that year, the winning few teams probably made in the 8 weeks, I'd say sort of 50 to 80% profits. I can't remember exactly. But, then in later competitions when markets weren't as kind, I remember in 2001, around when the Twin Towers came down in September, markets had a big fall. And I think the winner of that competition probably was at like 52,000 because the market fell. So, and I think actually the share game is a great sort of microcosm of how the market works generally, which is that on average, the average person out there is going to just get what the market return is. And it's the same in the share market game. If the market falls 5% during those 8 weeks, you can bet that the average player in the game is going to be around minus 5%. And then they're going to be distributed around that player or that sort of average player. So there's going to be some that have done, a bit better, some that have done a bit worse. The strategy to be the one that's done the very best, it has actually nothing to do with investing at all. And unfortunately, that's one of the sad things about the game is it doesn't teach people about investing. In 8 weeks, there's only one lesson you can learn, which is about speculation and trading, which is a useful lesson, but most people aren't going to become professional traders. And so it's not a very, reflective lesson of what investing should be like. I mean, my strategy for all of the games was basically to work out what were the riskiest, most volatile stocks available, and then take a view on whether those stocks were going up or going down, and put all of my money into a few stocks in one sector. So we still had to diversify at the time, but you could put 20% of your portfolio into 5 different very similar tech stocks, and they actually they actually would go up and down in a pretty similar way.
So you didn't look at anything like diversification or anything like that? Because I think Alec and I definitely agree that, in such a short space of time, it's incredibly difficult to apply the lessons that and the style of investing that we talk about on the show. And so, the way that you approach these is difficult.
I think the way that you talk about investing on the show is the exact way I approach it now, which is that, the most important things to think about are diversifying, spreading your money across different, assets and companies and industries and countries, and keeping your costs as low as possible. So not trading very much. Unfortunately, in the share game that lasts 8 weeks, if you do that, you're almost guaranteed to be just around the middle of the pack by the end, which in the real world is a good result. So, people shouldn't kid themselves and think that's bad. If you can be around the middle of the pack consistently, or a little bit above the middle of the pack because you're not paying so much in fees, you're going to do very, very well. However, in an 8-week competition, in order to do really, really well, you basically have to have a view and put all of your money in one place, which is a absolutely terrible strategy in real life, because you'll either do very well or you'll do terribly. And so, what isn't reported is that, while I won the share game 3 times, I also lost it lots of times very badly. But in order to win it a few times, you also have to take, big risks that sometimes don't pay off. And that's what active investing is about. It is about, taking risks. And that, even for the best traders out there, if 60% of your trades work out, that's actually a pretty good result.
Now, moving on from the share market game, we've been looking at some of the things you've written and just spoken about, and one lesson that we thought was particularly relevant for our conversation and for our listeners was the cryptically titled "Buy Straw Hats in Winter." So, as an introduction to some of the principles that you use at StockSpot, can you explain what you mean by this?
Sure. I mean, I think it's a pretty outdated saying. From memory, it comes from Warren Buffett or Charlie Munger. So it's actually a value investing quote, that it's not mine. I've misappropriated it probably. But I think in principle, and it's a principle I use with sort of my investing and the investing we do for clients, is that markets and different investments get out of hand and they get out of whack. So prices often go up too fast or they fall too fast. Now, it's always very difficult to know, how out of whack something is or how long it's going to last. So things can be too high for a very long time, or they can have fallen for a very long time. So it doesn't make a lot of sense to just not be in investing at all, or to, have everything in one place all the time. But what you can do to, reduce your risk and make sure that you can survive when things really fall is to make sure that, when some assets or some investments are doing well, that you're looking to kind of harvest profits or take profits out of those investments and put them into investments that aren't necessarily doing well. And so that's what I mean by buying straw hats in winter is, if you sort of think about the seasons and when people buy umbrellas, it's always when it's raining, but that's when, the 7-Elevens can put the prices up of the umbrellas and rip everyone off. And umbrellas aren't usually the best price when it's raining. And straw hats are, I think historically what people would wear in summer. I don't know how many people wearing straw hats these days. I don't even think Billabong sells many straw hats these days. They went out of trend probably 10 or 20 years ago. But maybe now is the right time to be buying them. To any of those listeners looking to set up clothing stores, straw hats could actually be a good thing to be buying right now.
Back in vogue. So it sounds great in theory, but we're in the US are in one of the longest bull runs they've had in history, and Australia is also doing very well in terms of economic conditions. So looking at the valuations of equities at the moment, a lot of them are at all-time highs and performing very well. Finding, I guess, straw hats in winter in this climate, is actually a bit difficult for some people that don't spend their days, all day viewing stocks and making an opinion on it. So what are you sort of looking at the moment that you think might be the next sort of straw hat in this climate?
Actually, all-time highs, if anything, is a good indicator of markets continuing to rise. However, what we know from people's behaviour is what happens at all-time highs is retail investors, so inexperienced investors, tend to sell because all-time high becomes an anchor where people are kind of, they see all-time high and they think they're getting the best price that anyone's ever got, and so that's a good time to sell. But usually the reason something's at an all-time high is because things are doing well. So the economy is doing well, margins are good, employment's looking good. And actually, institutions typically are buying at all-time highs because all-time highs are a signal of better times to come, not worse times to come. Now, occasionally, like you say, all-time highs, become all-time highs that aren't, reached again for a long time because markets can fall. And that's always what people are very nervous about, which is understandable because you don't want to be the sucker who, buys everything, at the top and then has to wait 10 years to kind of get back to break even. And so there's a few approaches to kind of, I think, reducing that risk, at least psychologically for people. One of them is, and I know you've talked about it before, which is dollar cost averaging or buying gradually over time.
Yeah.
Which helps to kind of, I think more than anything, it reduces that sort of mental stress of, thinking that if you suddenly bought everything today, you might lose everything. So the data actually shows dollar cost averaging does worse on average than putting everything in on day one. But
really?
Oh, a lot worse, because if you think about it, markets are trending up all the time. So if you're dollar cost averaging on average, you're buying higher and higher and higher. Yeah. So on average, you would have been better off to buy everything on day one. But psychologically, I think there's a lot of sense to dollar cost averaging. But sorry, going back to your other question, in terms of investments that, I guess we would look at that are out of trend at the moment, we invest in a bunch of different investments. And the only reason we'd kind of add more or less to an investment is through the process of rebalancing. And that's when one investment does exceptionally well and another hasn't done well, we'll tip money from, the one that's done well into the one that hasn't done well. And if we have a look over the last few months at where we've been rebalancing, it's generally been, first of all, out of global developed market shares. So out of like US shares and European shares and Japanese shares into emerging market shares. So shares in China and Russia and other emerging economies. The difference between those two investments in terms of valuation is probably at its widest level in 15 or 20 years at the moment. That's not to say that might not last a lot longer. That could last another 5 years or 10 years. But we know over very long periods of time, these things sort of come back, to more similar levels. And so that's one area that, we'd be buying, like the straw hats at the moment. And the other sort of unloved asset that we think adds a lot of value to a portfolio because it acts as a bit of an insurance policy is gold. And it's quite a controversial investment and there's, famous investors that love it and there's, famous investors that hate it. But we think it adds a lot of security to a portfolio because sometimes when everything else is going badly, gold is actually what is going to save your portfolio and stop you from losing a lot of money.
So that's one value, I guess, investing lesson that we thought introduced the premise behind StockSpot or like the philosophy behind StockSpot. A second one that we wanted to introduce before we talk about StockSpot specifically is your comment that the best advice is boring, which we thought was pretty profound the more you think about it. So I guess time to make us bored. What do you mean by that? And I mean, what is good and boring advice?
Well, here's a good example. So when it comes to being healthy, for instance, I think this is another place in life where the best advice is boring. So the best advice when it comes to being healthy is eat well and exercise. However, nobody really wants to hear that. Everyone wants the sort of secret pill that's going to make it a lot easier for them to get healthy without exercising or allow them to, eat badly and still be fit. So unfortunately, in a lot of areas of life, people are looking for sort of shortcuts and sort of secrets to success that are more exciting or require less work or, sometimes require more work, but just are a bit more interesting. But generally, these aren't the best ways of doing things. And I really believe in a lot of areas, like simplicity is the best way to do it. Having a good diet and exercise in theory, is pretty sort of simple in terms of a message. But in a world where there's, donuts and Tim Tams in your face all the time, that doesn't mean it's necessarily easy advice to follow. So advice that's simple doesn't have to be easy advice either. And I think all of that has a pretty strong parallel to investing. When you think about it, investing as a beginner, you probably think it's very overwhelming. You see there's so much information in the newspaper. There's, stockbrokers and newsletters, and there's all sorts of different ways to get information. And all of those different people are telling you different things. And there's lights flashing everywhere, and everything seems so immediate. And you feel like you sort of need to keep up with everything. And only by keeping up with things do you imagine that that's the only way you can do well. In fact, nothing could be further from the truth. The more that you focus on, reading the paper and listening to friends and watching experts on TV and the more actually you probably get worked up and the more your emotions start to come out and actually, harm your ability to make good investment decisions. So my philosophy and the philosophy I've carried through to the business I run, StockSpot, is that for most people, to get the best investment results, the formula is pretty simple, which is diversify, so spread your money and spread your risk as broadly as possible. Keep your costs as low as they can. And then the third one, which I think is just as important as those two, is learn to understand and manage your behavior. And that's, I think, the one area where an advisor or someone can actually come in and actually help someone get better results than left alone, which ultimately was the inspiration for starting the business.
Yeah, 3 pieces of advice that are always recurring from the best investors around the world. So they obviously work. Speaking of StockSpot and why you started the business, so StockSpot was Australia's first online investment advisor. I mean, it sounds simple, but when I said it to my housemates, we're interviewing Chris. He's the founder of Australia's first online investment advisor. Said, "What's that?" So, can you give us a bit of an idea on what the business is and what gave you the idea to start StockSpot?
Sure, and if you can think of a better way to describe the business, I'm all ears, because I'm always. I think robo-advice is very complicated and confusing and a bit intimidating for people, so I don't think that's the best way to describe it. But
yeah, I agree.
I mean, even online investment advice, it doesn't make a lot of sense. I mean, you guys are providing online investment advice to some extent.
No, we explicitly don't provide advice. We need to make that very clear.
So the inspiration for the business really came from, I spent my career after I learned to trade as a kid. I got my grad job actually trading money for a bank. I think I got pretty lucky at the top of the last bull market in 2006 and 7. I got a graduate job at UBS, which is one of the big investment banks and has a pretty big presence in Australia. And my job was actually to trade the bank's money, if you can believe such a job exists. So I didn't have to talk to any clients. I didn't actually have to talk to anyone within the business. I sat in front of a computer screen. I tried to learn about all the different sort of companies out there and all of the different assets. And then my job was to, manage a portfolio of those assets to make as much money as possible. And working in that world, what I realized is just how crowded financial markets really are. So I would go to lunches and to conferences, and there'd be hundreds of different analysts and fund managers and traders and hedge funds all clamoring around a business like BHP to understand their earnings results, for instance. And I thought to myself, how can all of these hundreds of different people who all are, extremely smart, they've all done, some sort of finance degree, probably got an MBA, probably got tons of experience. How can all of these different people think that they can all outsmart each other? Because when it comes to investing, it's not really about, whether you're smart. It's about whether you can outsmart all of the other people doing the exact same thing as you. And kind of following that line of thought, I started to, question whether sort of actively investing money for most people is the right thing to do. And by actively investing money, I mean either managing a portfolio of shares yourself or actually hiring a fund manager to pick the right shares and try and time the market for you. And so I started to research and learn more about this and started to get a better idea of really the history of financial markets and how really it's only over the last 30 or 40 years that financial markets have become, such a place to be. It's an industry where there's so much money to be made. It's really attracted so many smart people. But as a result of that, what's happened, it's described as the paradox of skill, which means that in any area where there's a lot of competition, eventually it no longer becomes about how smart the different competitors are overall, but it actually becomes about their relative skill. And what we've been seeing over the last 40 years in markets around the world is that the relative skill of different fund managers has been decreasing. So they're all pretty similar. There is only a tiny fraction of people out there that are able to outsmart the market consistently. And that made me realize that for the average person, the market itself, it gives you a great return and is a pretty great reflection of, what the fair value of different investments are. So people shouldn't really need to pay a lot in fees or, pay layers of costs in order to access the market. And this sort of realization happened around the same time when this sort of new form of a new way of accessing investments was starting to become available in Australia, ETFs, which I know you guys talk about a lot on the show. But I was so excited about these things because as someone who had actively traded money for many years, I was I think sort of humble enough about my own sort of skills and the skills of the rest of the industry to realize that actually this is the way most people should be investing. And the industry had basically, pulled the wool over most people's eyes around the actual value that they add. And that for most people, you don't really need to waste your money on paying expensive, advisors or brokers or fund managers to manage your money. You'll actually get, on average, a better result by not paying them anything. And that was a bit of an aha moment for me, which, was a moment I think a lot of investors around the world have come to, Warren Buffett included, realizing that actually for most people, the best way to invest is just in a low-cost fund that basically matches the market. And at the time, that it was very difficult to find any information about these sorts of things in Australia. What really shocked me was most financial advisors weren't recommending them. And there was not very many easy ways for people to access them, because even if you were using an online broker, it was quite hard to research, what were the right ones to buy, what should you be looking for, how should you combine them, and how should you manage them. So the inspiration for the business was actually, I had a few friends that were coming to me saying, how should I manage my money? And I would help them discover ETFs and learn about them. And I thought, hey, there's got to be a business model in this, because ultimately this is the way 90% of the population should be investing, but probably only 2% of the population, if that, even know about these things at the moment.
So you focus on ETFs and the advice is sort of automated. What's the process of recommending different ETFs for different investors? How do you take individuals' circumstances into account, given that it is all automated advice?
That's a great question. So there's a few, when it comes to investing for anyone, and it, sort of regardless of how you're investing, there's kind of a few important questions you need to ask yourself. And these are the sort of questions we ask clients in an online sense when they join up with us. Those questions kind of circle around a few areas. One of them is basically your investment time frame. So this is important because the longer you plan to invest, generally, the more risk you can take. Because in the short term, no one really knows where markets are going, but we know over the long run they go up. So the more you can withstand sort of bumps in the short term, the more risk you can take and the more return you can earn. So that's a question we ask people, which is how long are you planning to invest for? Another important question is whether people need cash or they need money from their investments along the way. So particularly retirees out there, they often need to draw an income from their investments. And so that will sort of impact what investments we recommend and how they're combined. Another important factor then is like your risk. I like to call it risk capacity. So people might have heard of risk tolerance before. I think tolerance isn't the right word because a lot of people don't really know how tolerant they are to risk until they actually are faced with a risky situation. But also people can be trained to be smarter around how they think about risk. So if you just ask someone and find out what their risk tolerance is, that actually might not point you in the right direction of what the right investments are for them. So we try and we try and understand people's risk capacity, their ability to take risk. And then also we combine that with their investment experience, because your investment experience, as we've discussed earlier on the show, will probably dictate whether you've lost money before, whether you've seen the ups and downs of market cycles. And that actually can, be a pretty good indicator of how you're going to behave if there is a fall. And then all of this information we basically combine to work out what is the right mix of different types of investments to help give you the best chance of reaching the outcome you want.
So I guess the question that we have to ask is, you take all that information into account and then you spit out a sort of suggested course of action. Given that the sort of robo-advice is growing as a sector in this financial advice market, how does StockSpot's advice differ from other robo-advisors?
Well, you're right. So around the world, like this area is growing really fast. And I think, last count, there's now hundreds of billions of dollars managed by different robo-advisors around the world. So, while we were the first in Australia, there's some very big businesses in the US and Canada and the UK and Germany doing similar things. And there's also been sort of similar guys pop up in Australia. So what I'd say is that the similarity between all of the robo-advisors that I've seen, or at least the biggest, robo-advisors around the world, is how they kind of approach, the combining of different investments, on a high level. So basically, how they decide on how much shares should you go in your portfolio and bonds go in your portfolio. Most robo-advisors use the same kind of theory, which was a theory that was developed in the late 80s and early 90s, and then won a Nobel Prize, the Nobel Economics Prize, which is known as portfolio theory or Markovit's portfolio theory. And this is kind of the most commonly accepted sort of framework for using different investments and combining them in the best way in a portfolio. So what I'd say is all robo-advisors are reasonably similar in their approach to that. Where they differ is in a few areas. So first of all, it comes down to how and you're actually choosing the actual individual ETFs in a portfolio. Now, we have a research process that we actually publish on our website, and every year we put out a research report that covers every ETF in Australia, which explains like how we select ETFs for each category and what factors we find are important. So even though other robo-advisors, might also invest in Australian shares, they may not invest in the same specific ETF as us because they may think other factors are important when selecting an ETF. So I'd say that's one area that's different. Another area that's obviously different is track record. So different service providers, obviously if they launched at different times in history, will have different timeframes of track record. Another area I think that we're a bit unique, and I haven't seen anyone else in the world go down this path, is we thought it would be a great idea to give our customers a little bit of control over some part of their portfolio where they can essentially pick and choose what investments go in. But we manage the risk of those investments. So we make sure that they're not going to lose too much money from them. So for a part of everyone's portfolio, we allow them to choose a few different ETFs across all sorts of different countries and industries based on what their personal preferences are. So there's a level of personalization that we've built into the product that we think a lot of people are interested in having. They want to have a little bit of control, but they want to feel safe and secure that they're not going to lose a lot of money. And then, I think the other area that we're very focused on is actually being a bit of a consumer champion in this area. So since 2013, every year we basically put out this research report, which is called the Fat Cat Funds Report. Now it's a bit of fun because super and investments for most people isn't a very sexy thing to think about or talk about. So I decided to spice it up a few years ago and have a bit of fun and create a bit of a research report, which is quite easy reading for people that can teach them about what's important when you're picking an investment. What are the best super funds out there and the worst super funds? And we call the best ones the fit cats. They're the ones that are doing well. And the worst of the worst we call fat cats. And every year we make a bit of a show about what the best and worst funds are. And we've gone and delivered trophies and checks to the worst funds for how much they've ripped off consumers by. So, we think it's pretty important to be out there raising awareness like you guys are about what's important with investing, because so many people, unfortunately, don't understand. And it can mean the difference between, buying something you want in the future or retiring comfortably and not. So, I think that probably explains how we're focusing on being different.
Yeah, I got to say, if our listeners want to jump online and have a look at the Fat Cat report, there's a tool there where you can just put your fund in and it will tell you how it rates. I definitely was playing around with that before. It's a great tool.
Yeah, it is good.
Yeah, thanks. There's a lot of things out there. I think ASIC has a pretty good website that does good work at explaining things to people. The challenge, as you guys know, is actually just making things really easy for people to understand, and that's the thing. Investing, when you boil it down to the things that matter, is actually quite simple. So if you can boil it down to those 3 or 4 things that people should care about, I actually believe that's what's going to make the biggest change in Australia, and is actually just helping educate people about those few things that are important.
Chris, you mentioned there that one of the advantages of going through a robo-advisor or StockSpot particularly is the comfort that the investor has knowing that you are managing the risk side of it and the exposure to downside. And StockSpot started in what has now become one of the greatest bull runs in history, and I would imagine that it hasn't faced a massive downturn for all of its investors. So what do you do in terms of minimizing risk and protecting your investors? Is that just done through ETFs as well that sort of short the market or have a bear approach, or do you actively manage it on your side in terms of moving between asset classes and cash and that sort of stuff? How do you minimize the risk exposure?
Yeah, another great question. So in terms of managing risk in a portfolio, there are different approaches. So you've explained 2 of them. One of them is to take some sort of hedging approach, so taking bets in an opposite direction. So you could buy a bear ETF is the example that, is a correct one. We don't think that's a great strategy in the long run because we know broadly that markets go up. We also know that nobody really knows when markets are going down. And then also products like that one and others that allow you to protect against the downside are actually extremely expensive. And I don't mean just in terms of their headline fee, but there's also other internal costs of products like that that relate to their hedging and their borrowing, which means that if you hold them for any extended period of time, regardless of whether markets go up or down, you're going to lose a lot of money. So we avoid products like those. We also don't take the second approach, which you explained, which is a more tactical approach. So taking bets on which things are going to go up or down. So, should we put more in Australian shares or global shares at the moment or in emerging markets? We don't think that's an area that we can add any value in. And actually, I don't think it's an area anyone can really add a lot of value in. There's very few people in the world that have been able to consistently predict and make money out of timing, when and which investments to get in and out of. Because often, investments that are expensive stay expensive for a long time. So you can be wrong for a very long time. So both of those approaches are common in the industry. We just don't think they add any value to customers. Rather than that, we take what is known as a strategic asset allocation approach, which means that rather than try and time the market or protect against risk, which is quite expensive, we look at the long-term history and relationships between different investments and then try and combine them in a way that is going to give people some cushion if markets fall, but then give people most of the profits if markets rise. And I can probably give you an example because you mentioned there hasn't really been a big fall since we started. There sort of has been one. So between I think it was April 2015 and January 2016, the share market fell about 20%. Okay. For most people, that's a pretty big amount. So by actually combining our assets in a way that helps to protect the downside and also we have in all of the portfolios investments like bonds and gold. Bonds and gold actually rose in price during that period when shares fell 20%, which meant that even the riskiest of our portfolios in that period when markets fell 20% only fell 10%. So actually, one of the ways that we look at protecting risk is actually just in getting the correct mix of different assets in your portfolio. And we don't change that very often. So there's very few reasons we'd actually change that mix of investments. Yeah, that kind of, it might be a little bit too technical for listeners because it relates to the volatility of assets and the covariance, which is like the relationship between different assets. But ultimately, our aim is to give people some protection if markets fall, but access to most of the gains if markets rise. And historically, the way we're going about it has done that very well, not only since we've existed, but if you trace back history and use a similar method. I guess the other way, which isn't really related to the portfolios, goes back to what I said before about behavior. We take a pretty proactive approach when markets fall of reaching out to clients, through all sorts of different channels, whether it's through social media, through our email, through our blog, through phone calls and through our dashboard to actually educate them and keep people calm and focused on the long term. Because we know that people, do need a bit of hand-holding when markets fall, especially first-time investors get quite nervous. It's the most dangerous time for most first-time investors is the first time they've lost money and they're getting nervous. But as long as they realize that they're in the right strategy for the long run, and that their time frame, is still appropriate and they're still, looking to invest for a few years, then there's really nothing that needs to be done when markets fall from their part because, we know that, as long as you've got a bit of time, markets are going to work on your side.
Some great comforting advice.
Yeah. So
over to you, Ren.
Yeah. So Chris,
that's boring advice, but hopefully comforting advice.
So you mentioned bonds and sorry, I've gone blank here. Bonds and what was the other counter-cyclical asset?
Gold.
That's right. Yeah. Do you try and use cash strategically as well and sell as market gets higher, or do you try and stay fully invested at all times?
No, so cash is an interesting one. Cash really isn't an investment asset. So I don't think cash belongs in a portfolio. I think cash does have a place. So I think everyone should have some cash as part of their overall asset mix. And usually cash has a place as a bit of a safety net or a rainy day fund. So no one should ever have money that they might need to sort of dip into in the short run if they lost their job or if they had a medical emergency in shares or in markets. That should always be in cash. But in terms of your investment portfolio, cash can never really have a place. And I mean, I think your example kind of makes some sort of sense that in theory, you'd think that you should have some cash because if markets rise, you can deploy that. If markets fall, you can deploy that cash. The problem is nobody really knows when markets are going to rise or fall. So you might be sitting on cash for decades, and that cash is going to really harm your returns. I mean, there's a beautiful example of this, if anyone's interested in a bit of a history lesson, which is in the late 70s, there was a famous newsletter writer in the US who wrote a stock tipping newsletter. And he would always tell his readers whether they should be, invested fully or all in cash. So he only kind of had an on or an off switch, but he had a pretty good track record throughout the late 70s and early 80s. He got it right, more times than he didn't. And he got a huge subscriber base of people that followed him. And then I think it was early in 1981, he basically went out with the call to his investors and to his subscribers and said, okay, everyone, the market's at a short-term high. I want you to sell everything and go to cash. And I'll let you know when to buy back in. So everyone went 100% cash. Now, unfortunately, the market actually never went down from that point. So from 1981 to when this newsletter writer, I think eventually died in 2014 or 15, the market actually never fell, and he never reversed his call. So he waited and waited and waited, and he lost hundreds and hundreds of percent in returns over that time. And he goes down as the worst stock tipping newsletter in history because he told everyone to sell in January 1981 and he never changed his mind. So it shows that, if you're wrong and you have all of your money in cash and you just wait, that can be just as disastrous as investing and watching the markets fall.
Yeah. Now, look, I love that answer because I agree pretty wholeheartedly with that. Unfortunately, my co-host has a different opinion. His portfolio is currently 60% cash because he thinks that the end is nigh and something's about to happen or something will happen in the next year or two. What do you reckon about that?
Well, I had a lot of confidence on September 14, actually.
Yeah, that came and went. But
so did I.
I mean, it's an interesting question when you're actively managing. From my sort of prior experience actively managing money, when you're actively managing money, the hardest thing to know is, when you have a hypothesis or a theory about what's going to happen, as new information comes out, at what point do you, capitulate and say, hey, I was wrong. I've got to get back in or I've got to sell. And it's a very difficult thing for active managers to do. Now, you might eventually be right, but when it comes to investing, if you're eventually right, but your timing's wrong, that's pretty much as good as being wrong. Active investing is really, really tough and you can be sort of eventually right. But what you typically find is across the cycle, you might be right a few times, but then you'll be wrong a few times, and those will probably cancel out and cost you everything you gained when you were right. So, look, it's a difficult one. There's always going to be people out there that want to take a bit of an active view, and I think that's absolutely fine. I think, there's always a tendency that people have to, want to be more active. So, and I think that's probably a great way to learn about markets is actually by taking a bit of interest and having a view. And I think the way I'd sort of look at it is recognizing that your view should be able to be fluid and change, but also that view shouldn't dictate 100% of your portfolio. Let your active decisions maybe dictate 20% of your portfolio, and with the 80%, that part can just be invested, recognizing that your active part may or may not be right.
Yeah, that's an excellent point. Something that I've been mulling over for quite some time now because, you're right. it's getting to a point where I'm like, how long do I hold on here? And Ren keeps saying the moment you put all your money in is the moment that the stock market's going to go down.
Yeah, I mean, I have a similar sort of story as like one of the colleagues I used to work with. He for many years and probably decades was really sort of negative on residential property prices. Hated it, said it was going to crash. And so we had a bit of a running joke at work that as soon as he said he's bought a property, that's when everyone else is going to sell, because that's when the last non-believer has finally bought. And I think, to be fair, I think he bought in 2016 or 17, so he might have been a year ahead of when he picked the top.
Well, yeah, look, I think, I'm getting to the point now where I'm more thinking about the asset allocation in terms of how much cash is suitable. Certainly definitely still have a view that, having maybe 20% rather than 60% is probably the better way to go, because, I've definitely left some money on some profits on the table over the last few years. So,
yeah, I mean, I think if you have that strategy, the other side of that strategy is make sure, I don't know if you've already thought about this, but what I'd be doing is actually kind of writing in your journal or writing down somewhere like at what price, at what levels you actually would buy more and how much more, because there's a huge temptation then if markets do start to fall and you're right, that you might actually miss it because you might keep on waiting and it might not quite fall as far as you thought. And so you actually, you're sort of right, but not exactly right. And then, markets might go all the way back up and you might have still been waiting for it to fall to exactly where you were waiting for. So I'd almost say a good way to de-risk what you're doing is at least have some lines drawn in the sand where you say, okay, if markets fall 5%, I'm going to buy 5% more. If markets fall 10%, I'm going to buy another 10%. So then you have the comfort of knowing you've got a bit more of an automated strategy around, buying if your theory's right.
Yeah, true. Great point. So, Chris, we'll just move on a bit more of the practical side of StockSpot before we jump into our final three questions of the show. For those beginners that do want to partake in what you offer, is there a minimum investment? What are the fees around it? Can you dollar cost average your way in and all this sort of stuff? What are the practical ways that we can sort of use StockSpot?
Yeah, sure. There's a few different ways. I mean, our clients vary quite a lot. So our minimum investment is $2,000, and we've got a lot of clients that start with that, and then making $100 deposits, every few weeks, or just adding money as they've got extra savings. So that's a perfectly good strategy and a good way of getting started in markets. I do think for beginner investors, dollar cost averaging is a great strategy, for the reasons we were talking about before, which is that, psychologically that can really help insulate you from, being worried about markets falling, because that if they do fall, you can take advantage of it and actually buy some at those cheap prices. So we have clients doing it like that, all the way up to we've got, a few much bigger clients that are, $2-3 million clients that are, just sitting on an investment for the long run. So they might not be dollar cost averaging. They've just, put in, their self-managed super fund or a family trust or something like that. And they're investing for, 10 years or 20 years. And they're just looking for a good return like that. So, I mean, to get people started, we basically say to people, we're not going to charge fees for the first 6 months, so people can get started if they're investing less than $10,000. And that allows people to start to dollar cost average and build up a balance. And then we don't charge for brokerage. We just charge up to a $10,000 balance, a $5.50 a month fee, which essentially covers our cost and the cost of managing your money. And then as a percentage, that decreases as you invest more money. So, which is a pretty typical model in the industry.
Yeah.
Nice one, Chris. So we have reached our final three questions. Now these are the questions that we end every interview with. So first one, what is your go-to source for investing information?
There's a few, I'd say. So first of all, I love reading books about the history of markets and people that have been involved in the history of markets. And so, on holidays recently, I either read the hard copies or on my Kindle, but some of my favorites. My favorite trading book of all time, which I've probably read, 6 or 8 times, and every few years I try and pick up is called Reminiscence of a Stock Operator, which is actually about a trader in the in the early 1900s. And I think what it basically teaches is so many of the principles when it comes to trading and managing risk haven't changed over the years. That's very much a trading book, so I wouldn't recommend it as a way of learning about investing, because it's going to put you in some bad habits unless you want to become a professional trader. But otherwise, I just love reading about other famous investors in history. So I read a few months ago a biography about George Soros, who's a famous macro trader. And he was the guy who famously broke the bank, he was shorting a lot of sterling when the Bank of England basically couldn't support it anymore, and he made a few $1 billion in a day. History books is one place, and the other is podcasts. So there's some great investment podcasts out there these days. You guys included. I mean, one of the US ones I love listening to, which is a similar sort of format, like interviewing interesting people in the industry. Is called Masters in Business. And I think they, interview some really fascinating people who have had, huge historical significance in investing. And for anyone that's wanting to learn about investing from, a lot of, grey-haired people in their 70s, 80s and 90s even, mainly in the US, like that's a great way of getting a bit of history. So I'd say those two are probably my main source.
Yeah, nice one. Now, the second question, which you've already kind of answered, is are there any must-read books? But this can be investing or otherwise. So I know you've already mentioned the George Soros book and Reminiscent of a Stock Operator, but are there any others that you think are must-read for our listeners?
I think so. Those two, they're quite different. The two I think everyone should read as first-time investors or anyone that's looking to manage their own money are a book called Thinking Fast and Slow, which is more about the psychology of managing money and written by, a couple of people of which who won the Nobel Prize for Economics as well. And then there's a similar book which also looks at psychology of investing in a slightly different way, which is called Nudge. So I think those two should be high on anyone's reading list, because they'll actually help you understand, why you're feeling a certain way or why you're thinking a certain way when you're investing. So if you can start to identify some of these kind of weaknesses, it will actually make you a better investor.
And if any of our listeners are interested in that Thinking Fast and Slow, which is by Danny Kahneman, or Nudge, which is by Richard Thaler, they will be in the show notes for this episode. We'll have links to both those books and the other ones we mentioned before. Okay, so third and final question. If you could go back to your early investing days and tell your 10-year-old self any piece of advice, what would it be?
Yeah, another tricky one. I think I'd probably give myself the advice, which is actually probably my favorite investing quote, and I have it written in a few places on my desk and in a few other places, which is a Latin quote, and it's res tantum vale quantum bendi potest. Have you ever heard that?
No, I haven't heard that one.
So, it might be an unusual way to end the show, but actually that quote is a famous quote, which means a thing is only worth what someone will pay for it.
Okay, I like that.
And I think it's a pretty important one when it comes to investing and trading, because it actually explains so many things that happen in markets. Why markets go up too far or fall too far, but also why they can stay crazy for a long time. And it really comes down to the fact that markets are driven by people, and price is really just the function of like two people getting together and agreeing on a transaction. I think that's a lovely quote that sort of explains how markets work. And it's one that if I understood better from an earlier age, I probably could have avoided losing a lot of money.
Great way to wrap up, Chris. It's been fantastic to have you on the show. Thank you for joining us. I've certainly taken away a lot from this interview. I'm going to invest 100% of my cash. No, not really. Really, really appreciate you coming on the show and sharing some of the insights there. I know that a lot of the listeners out there are playing along with the ASX Sharemarket game, so hopefully they got something out of it. And, it's great to have the resources such as StockSpot out there for people that do want to be in the market, but, want to have someone else look after the risk and the rebalancing side of things. So I guess, is there any way that people can contact you? Do you have a Twitter or a social media, or what's the best way that people can make contact if they wanted to?
Sure. I mean, they can find me on Twitter just under my name, Chris Brycki, or under our business name, StockSpot. And then on Facebook as well, you just look up StockSpot. We're building a pretty big community there. So, yeah, thanks for having me on the show, guys. You're doing a terrific job, raising awareness and educating people about investing. So, yeah, keep up the great stuff.
Thanks for coming on, Chris. Again, I really appreciate your time, and I'm sure we'll keep in touch.
Thanks, guys.
Thanks, Chris.
Hello, mates of Equity Mates. Or I guess that just makes you equity mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. I mean, we hate spam. It's once a week and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.